Welcome, ladies and gentlemen, to a new edition of our interview presentation here at Commodity TV. And uranium is hot. Uranium broke out, and we just approached this morning $50.80 per pound, which is, of course, something we have told you guys for the last years, I would say even. And now it is there. The breakout in uranium is there. And we want to do an interview presentation with one of the real top shots in the sector, Consolidated Uranium. And Phil Williams, the CEO, is with us here today. So good morning to Canada. How are you doing, Phil?
I'm well, Jochen. Good morning to you.
Thank you. Perfect. So let's get started. And I bring up the presentation. So I would say the floor is yours, Phil.
Thank you very much. And we're very excited to be presenting here today, given what's happened in the market just recently. So Consolidated Uranium is a new player in the space, and I think it's very well positioned to benefit from what's happening in the spot price environment. Our mandate when I started the company about a year and a half ago was to acquire and develop uranium projects around the globe. To date, we've now secured over 12 projects in 4 different jurisdictions around the world: Australia, Canada, the United States, and Argentina. As I said, I think we're very well positioned to benefit from the coming bull market in this space. With every presentation, we have some forward-looking statements. And so really, this is the summary of the company. We're an emerging new player in the uranium sector. As I mentioned, we've acquired over 12 projects since early last year. But what we have is we have the right strategy. So we're talking about the uranium market a little bit more. It's just come out of a 10-year bear market, and it's really enjoying a renaissance, and a well-deserved renaissance for a lot of good reasons. The consolidation strategy that we're deploying generated outsized returns in the previous market, and we'll show you why we believe that it's going to generate outsized returns again in this current market. The company is backed by the right team. Originally, the company was founded by the team behind NextGen and Mega Uranium, and many of those guys are still involved. I joined recently and have brought on some new management and new directors who also have tremendous experience both in uranium, but also in mining, finance, and mergers and acquisition, important components of our business. And the portfolio, we've specifically diversified it across geography, stage of development, and deposit type. And we think that brings us a lot of benefits relative to our peers. And most recently, with our acquisition and strategic alliance with Energy Fuels, we now have projects in the strategically important US market, which are positioned for rapid restart as market conditions continue to improve.
So Phil, that means with your portfolio that you have like exploration stage, development, and ready to production, right? So that means you want to cover the whole sectors in that sense.
Correct. And as I'll talk about in a second, we don't really have that many exploration projects, Jochen. What we focused on in our acquisition strategy was projects with resources in place and significant past expenditures. And then as we move further up through the portfolio, we have projects past producing mines and mines that we can bring on relatively quickly, again, as market conditions continue to rebound. So here we have a company snapshot. This is something that the audience can look at in their own time, but I think what's important to highlight here is that with over $20 million Canadian in working capital, we're well funded to execute on the acquisitions that we have in hand and move some of those projects ahead, spending the money judiciously on activities which we think can add value very, very quickly. I think the other thing.
Sorry, what are the exercise prices and maturities of the options and warrants? Just briefly, not in detail.
So in the last year and a half, we've raised $25 million in 5 different private placements. Each one was at a successively higher price, and we've raised more money. And each one of those financings came with warrants, and they would go anywhere from $260, which is the latest round, down to $170. And then down to as low as 30 cents. But we're getting warrants exercised on a regular basis now, given the performance of the stock.
Mm-hmm. Super. So that means you have like constant cash inflow.
It seems that way, and rightly so. I mean, the stock is trading with increased liquidity and much higher than a lot of those warrants. So people are obviously exercising them and supporting the company by putting more money in the treasury. I think the other thing that I would highlight, which is key here, is that with those financings that we completed in the last year, we've secured some excellent investors, particularly institutional investors who are focused on the uranium sector. And we list Sachem Cove and we list Mega Uranium on this page, but there's a number of other funds that the audience might have come across who are focused on uranium. They've done a lot of work on the company. They understand the model, they understand the potential, and they backed us multiple times now. And I believe they'll be there to back us in the future as we execute on new opportunities. I won't spend too much time talking about the team, although my background I think is important. I've been in the uranium space since 2006, and I've had a myriad of different roles. So I've been a sell-side research analyst, I've been on the buy side. I worked at a fund that was very much focused on the uranium sector. I was a managing director of investment banking for a dealer here in Toronto that was very focused on uranium. I think in the period that I was there, we raised almost $1 billion in equity for uranium companies. And since 2017, I've been an entrepreneur. This is now the second company that I'm the CEO of. The first one was a uranium-focused royalty company, which is now public and has been very, very successful. And so I bring a tremendous experience in the space, including having been to over 100 projects around the world. As I mentioned, the board we've added to the board lots of experience both in mining, finance, M&A, and uranium. Importantly, there's a name on the list there, Mark Chalmers, who's the CEO of Energy Fuels. As part of our transaction with Energy Fuels, Mark will be joining the board. Mark is a veteran of the uranium space with 40 years experience and brings a tremendous amount of value to the company. We also, as I mentioned, we've maintained some advisory board positions with the gentlemen that are behind NextGen, including Lee Currier, the CEO, and Richard Patricio, who's the CEO of Mega, but is also on the board of NextGen. Talking about the commodity price, of course, uranium has broken out here, and I think everybody knows what's been happening with the Sprott Physical Uranium Trust and their purchases they've been making in the spot market. We think this is just the start. Obviously, there was a 10-year bear market in the space, and as I always say, the cure for low prices is low prices, and with 10 years of low prices, we can expect prices to go significantly higher from here. The other thing that I would highlight in our portfolio is our exposure to vanadium. And quite often around the world, uranium projects do have a vanadium byproduct credit. We do with a number of our projects, and I'll talk about that a bit more as we go. But vanadium itself as a commodity has been up over 90% this year. And so the exposure that we get through vanadium is not insignificant, and I think it's something that investors should be paying attention to. When we talk about this consolidation strategy, this is a strategy that was deployed very successfully in the past bull market. And in this slide, we just highlight one of the players that executed this strategy successfully, being Mega Uranium. This chart that in front of you is a 2-year period from the beginning of 2005 to the end of 2006, where Mega completed 9 acquisitions and raised $50 million in the public markets. Over that period of time, the share price increased from $15 million to $940 million. And really, this is the guide for Consolidated Uranium. Why did we enter this space, and why are we pursuing this strategy? It's really because of the success that Mega had in that past cycle. We also show on this chart the performance of the uranium price, so that's in green. And uranium the spot price moved from in the mid-20s to the mid-60s on its way to $130 in early 2007. So of course, there were strong tailwinds behind the commodity price when Mega was executing this strategy. And I feel like we have the exact same conditions today, and with the benefit of hindsight in terms of how Mega executed this strategy, I think we could be equally as successful as they were. And Mega was not the only player to do this. Names that the audience would know, like Paladin, Uranium One, Energy Fuels, of course, who we're in partnership with, but also a company called Energy Metals, which was taken over for over $1 billion in the last cycle, also executed the consolidation strategy very successfully. Take a second to talk about our strategy, and we highlighted at the beginning the diverse portfolio approach. And really taking this approach, having been around this space for a long time, we recognize that uranium projects particularly can be derailed overnight for reasons that are completely out of control of the company. And typically there are geopolitical events where a jurisdiction decides to either ban or place a moratorium on uranium mining, or there's not social acceptance for uranium mining. And so what we decided to do was, from the get-go, create a portfolio that diversifies our exposure away from any single project in any single jurisdiction. So one of the projects in our portfolio that's derailed for some reason, we have many other projects that we can focus on. We've also only focused on projects with significant previous expenditures, including historic resources. So all of the projects we have in our portfolio have resources and attractive development characteristics. And we'll touch on our acquisition structures, but I think we've done a very good job staging our transactions such that we typically pay a smaller amount of consideration up front, and then the balance of the consideration is over time or tied to much higher uranium prices.
Phil, are you seeking then for partners, like for example royalty companies? What are you doing to really develop all those projects? I mean, with let's take the chart from the last slide, for example. This was only until $60. My feeling is that the $60 we might have already this month, and it might be until Christmas, yeah, even higher. So it looks like that we have a that, let's say 2005, 2006, 2007 is repeating almost. Yeah, so you have a lot of projects which can be really developed, but I think it's very difficult for you to develop like 5 or 6 projects on the same time.
Yeah, no, that's a great question, Jochen, and it really leads into the next phase of growth here. And I'll tell you that when we first started the company and we're acquiring these projects, our plan was to acquire them and hold them and not do any advancement. And really, at the low uranium prices that we were seeing when we were making these acquisitions, there was no reason to work on the projects. Our capital was better spent acquiring new projects rather than developing the ones that we had. I think that's clearly starting to change, and I think the market's going to want to see us develop these projects. And so we're right now we're looking at the portfolio and identifying the projects that are at the top of the portfolio, which we'll focus on in this presentation, that being the Energy Fuels projects and the Matoush project in Quebec. And then the other projects will give us opportunities to maybe look for bringing in partners or creating new vehicles to develop those projects outside of Consolidated itself, which is not too dissimilar to the way that Mega Uranium executed the second half of their strategy. But I would say that at the same time, Jochen, we're not done on the acquisition front. We see many opportunities to continue to build the portfolio with complementary acquisitions. We also believe that scale matters in this business, and we're seeing some M&A in the space already. And I think that where groups believe that getting together and bulking up will be beneficial to the long-term growth and access to capital for the business, we see the same thing for us, and I think we'll be at the forefront of some bigger potential M&A in the space. So this is the portfolio, and I like this slide because it really will give the audience a snapshot of where all the projects are and what the significant resources that we've put in place. As I mentioned, we're in Australia, we're in 3 provinces in Canada, we're in Argentina, and most recently we're acquiring this portfolio of projects from Energy Fuels. And the significance of the resources that we have in place when we add up the indicated resources and the inferred resources on the right-hand side of this map, you can see we have quite significant both uranium resources and vanadium resources. What we're going to do for the rest of the presentation is really focus on the 2 sets of projects in the darker green boxes. Again, that's the Matoush project in Quebec and the portfolio of past producing mines that we're buying from Energy Fuels. So let's start there. This is a map of the projects that we're acquiring. These are historic mines in a prolific uranium district. This is the Colorado Plateau. As I said, there's resources in place. We also believe there's good exploration potential in all of these projects. The key to this portfolio is that it's all of these projects are proximal to the Energy Fuels White Mesa mill. So right in the center is that mill. That's the only operating conventional mill in the US, again, owned by Energy Fuels. And as part of our strategic alliance with Energy Fuels, we have guaranteed access to that mill. That's unique. None of our competitors have that. The only 2 companies right now that have guaranteed access to the mill will be ourselves and Energy Fuels itself. These projects, particularly the Rim mine, the Tony M mine, and the Daneros mine, which are on the left-hand side of the map there, are past producing mines. You can see that they produced as recently as 2013 for Daneros, 2009 and 2008. And importantly, since they went offline, they've been kept in good standing, both from a permitting perspective and the care and maintenance perspective by Energy Fuels. So they could be turned on relatively quickly and be back in production as market conditions permit, probably faster than many of the other projects, particularly in the US, that some of the audience might be familiar with.
Phil, that brings a question up to me. What is the incentive price for those mines to go in production? Meaning cost-wise per pound, of course. What do you need? Do you need longer-term contracts to make sure production is safely sold, parts of it at least? Or what is the price you need? Is 50 already enough to restart?
So Jochen, I can't give you the exact number today, and I'll tell you why. One of the things, once we close on this acquisition, which we're expecting later this month or early October, we're going to undertake some economic assessments of the projects. We can look at the historic prices as a guide, but of course, these mines haven't been in production for, in some cases, more than 10 years. So we can't totally rely on those numbers. And in order to give the audience the proper numbers, we're going to go ahead and do those economic studies. I will tell you, though, that we're getting close, and at these prices, we're certainly starting to get into the range where these types of conventional mines would make sense to bring back into production. I would say the one thing that we would say with respect to long-term contracts, we're not necessarily looking for long-term contracts, particularly contracts that cap the upside of what we can get in terms of spot price. What we'd like to do is maintain as much exposure to the spot price as possible, and so we'd only entertain contracts which gave us that upside, and we think that's important for our shareholders. We think that's what they're looking for in our company, is they want maximum exposure to that fast rising spot price rather than capping that exposure through some kind of long-term contract which may fix the price or put some kind of cap on it. Moving on to the second part of the acquisition, and really we look at this as more than just acquiring projects from Energy Fuels. We're entering into this strategic alliance, and for people that don't know who Energy Fuels are, they are the largest producer of uranium in the U.S. Their market cap is over $1 billion, and as I pointed out in the last slide, they own the White Mesa Mill, which has over 8 million pounds of production capacity per year. As part of this transaction, we're entering 3 separate agreements with them. The first is a toll milling agreement, which I referenced previously, which is unique. We're the only company now with a toll milling agreement with Energy Fuels. Well, we're also entering an operating agreement where Energy Fuels will continue to operate these projects on our behalf, and that's a significant advantage for us as a small company. We don't have to build a full team of people down in the U.S. to take care of these projects. And particularly the Energy Fuels team is great at these projects. They know them, and they've been obviously keeping them in good standing for many years. So we're very happy that they're going to continue to do that on our behalf. And then the third aspect is this investor rights agreement, and it's worth just taking a quick run through the terms there, which you can see in the bottom right table. But on close, in addition to $2 million in cash that we're paying for these assets, we're giving them 19.9% of the common shares of CUR. And so they'll be their biggest shareholder, and they get certain rights that come along with it, namely participation in future equity financings. They get to put a person on the board of directors, which of course is Mark Chalmers, as we referenced earlier. And then there's some commensurate rights on the other side. They do have some resale restrictions ultimately on those shares. Moving on from the Energy Fuels portfolio, the next sort of key project in our portfolio is the Matoush project in Quebec. We completed the acquisition of this project on August 19, 2021. We bought this project out of bankruptcy. We're very excited about this project, particularly because of the high-grade nature. In the indicated category, at a grade of over 0.95%, it ranks as the second highest grade uranium project in the world outside of the Athabasca Basin. And of course, we all know that the grade is king, and these are spectacular. This is a spectacular grading deposit. The project itself has significant past work completed on it. Our estimate is that the previous owners spent over $100 million on this project, and to let the audience know, we're paying about $10 million for the project in a combination of cash and shares. So we think that we're buying it at an extremely low price relative to the work that's been done on it. Significant amount of drilling, multiple resource estimates. There was a lot of infrastructure put up at the project. But also we think there's tremendous exploration potential. And if you take a quick look at that map there, you can see the mineralized zone in the yellow, but there's kilometers of strike to the north and the south, which is untested to date. Our strategy here is to engage with the local Indigenous stakeholders before undertaking any project level activity. But we see this could be a very important part of the portfolio going forward and become a potentially world-class deposit.
And those Indigenous stakeholders, they are positive on uranium?
So the answer is historically no. And this is part of the story behind why this company went bankrupt. 10 years ago, the previous owners could not get support of the Indigenous stakeholders. And fast forward to today, this is why this is our job number one. And we think that this is a process that we have to take in terms of engagement with the local Indigenous groups and education around the safety around uranium and uranium mining. And so we have a strategy to undertake that, and we're starting the engagement with those groups in the very near future.
Good.
And then for the rest of the portfolio, we've put them in a table here. And each of these projects, as we point out, has uranium and vanadium. There's resources in place. There's significant expenditures completed in multiple different economic assessments or resources put together in the past. We would, of course, have to update all of those reports to be current for ourselves. But with each of these projects, we see various opportunities both to do some work in the immediate term on our behalf, where we think we can add some significant value to these projects, but also we'll look at opportunities, as we discussed earlier, to potentially work with other groups and partners on advancing these projects. And then this is a table that we put together as of close on last Friday night, and where the company sits on a relative value chain. And I think certainly we're at the low end of the range. And I would think that's mainly driven by the fact that we're a very new company. We're not as well known as many of the other names on this table, and I think that the rest of the group, the rest of the market needs to understand what what we have in the portfolio and what the ultimate value potential of these projects could be in order for us to trade in line with our peers. And we've highlighted how peers trade in the various jurisdictions. Particularly, I would highlight in the U.S. You can see that companies with projects in the U.S. get a significant premium valuation to the rest of the countries. And so as once we close on the Energy Fuels acquisition, we're going to, I think we're going to re-rate in line with our peer group. So that's the story, Jochen. We think we've got an attractive portfolio of projects with high grade on a global scale. We have near-term production potential. We're very busy, continue to evaluate new opportunities, and using our diverse portfolio approach and our unique and flexible acquisition structure. We've got a compelling valuation, as we illustrated in the last slide, and we're well funded with over $20 million in working capital. And then overlay that with the proven track record of the people involved, decades of experience in the uranium sector with proprietary knowledge. I think we're very, very well positioned to outperform in this coming bull market.
Fantastic, super, Phil. Thank you very much. I bring that back here. One last question I have, of course. What is your personal take on the uranium price? I mean, you're also very long in this sector, and we know each other also when you have been like a financial researcher and analyst. So you must have also a personal opinion.
So yeah, I do, Jochen. And my opinion hasn't changed from when we started this company. And my thought was the price is just not high enough to support the mines that are required to provide the supply for the fleet of nuclear reactors, not only that we have, but the growth that we're expecting. So between new reactors that are being built and coming online, and some of the new technologies that are being investigated, particularly around small modular reactors, I see a very bright future for nuclear power. And the mining side, the supply side, will not, in its current form, is not going to be sufficient to supply that material. And in order to become sufficient, we needed much higher prices. So that, I believe, that underlying thesis still holds. what's happened lately, particularly as the financial player, and it's all over about the Sprott Physical Trust comes in, as they're buying material up in the spot market, that's accelerating the dynamics to move the price higher on the spot basis, but ultimately that will support higher prices on the long term and the contract basis. And it's really a question of when particularly the utilities come to the market and decide that they need to enter the contracting market. And so it'll be when they come to the market, and then I think it's going to come down to the producers to say, hey, wait a minute, we're not prepared to sign contracts at these low prices, or the types of contracts that we're going to sign, we want to maintain exposure to the upside. And I think that dynamic will be the key to continue to pushing the market higher to the level that, quite frankly, it needs to be in order to support new mine development.
Absolutely. Honestly, it reminds me again, like 13 years ago, because I think at that time, 2005-06 was the hedge funds who started to buy uranium. This time it's Sprott, together with some other buyers like UEC, for example, bought also for their company. Yeah. And the only question is, when get utilities nervous?
I think they're getting nervous now, quite frankly. It's just a question of when they're going to move. Yeah. And we've seen it in the past. When they move as a group. And so if the first one or two break ranks, then the rest will come to the contracting side, and it could get quite frenzied, like we've seen in the past cycle.
Yeah, so maybe we get a nice Christmas gift with $100 plus uranium.
Listen, I won't go out on a limb that far, but if it happens, Jochen, I would be very happy, and I'll buy you a nice bottle of wine.
I love that, because I'm a shareholder of your company, also long-term shareholder. So I would be really happy, because I could imagine then your company is probably $8 or $10 or even more. So that would be great. Fantastic. Phil, thank you very much for a great presentation. And definitely your company is worth to be considered. That is for sure. And I really urge our viewers to have a very, very close look onto this fantastic company. Phil, thank you very much.
Thank you so much. It was great talking to you as always.
Thank you. Yeah, ladies and gentlemen, that was Phil Williams, the CEO of Consolidated Uranium. And yeah, you saw it probably already. The share price really appreciated nicely. But this company is really fantastic. And as you heard in the last 25 minutes, then you know why. Because the setup of the company is really fantastic. Also that they work together with Energy Fuels, and with $21 million in the bank, 12 fantastic projects in the portfolio, and not stopping to add good projects. I have a very good feeling that this is one of the real good vehicles to participate in this just started uranium boom. So thanks for watching us, and bye-bye from Switzerland.